Hi, today we're going to learn about petty cash funds. The petty cash fund is an account that is established for payment or reimbursements of minor expenditures with cash, or put simply, a company's cash on hand. Under the care of a designated custodian, the operating activities of the petty cash fund are as follows: establishing the fund, making payments from the fund, and replenishing the fund. To establish the petty cash fund, a check is written for the amount required. This obviously differs from company to company, but the check is then cashed and a journal entry is made to record the establishment of the fund. Here we can see a journal entry has been established for petty cash in the amount of $500. Since petty cash is increasing and cash is decreasing, the two are debited and credited respectively. It must also be noted that the total assets remain the same. This is because petty cash has increased assets by $500, while cash has decreased it by the same amount, bringing the total back to zero. Now that petty cash has been made, it can be used to make payments for the necessary expenditures. Payments can be made either directly in cash or to reimburse an employee. The custodian should seek receipts for all purchases, but there is no requirement for journal entries to be made, as they are only recorded when the fund is replenished. As payments for expenditures are actively made from the fund, it eventually requires replenishment. To do this, the company cashes a check for the amount required to bring the fund back to the original balance. The receipts are used to document and record all expenses. This can be seen in the replenishment report, where a total of $310 is owing for replenishment of the fund. The total expenses also equate to $310. To replenish the fund, a check is cashed in the amount owing for the total expenses. This can be seen in the following journal entry for Lankan Timber Music. The entry increases the expense accounts and decreases the cash account in the amount of the check. The expenses and cash accounts are thus debited and credited respectively. In addition to this, as the fund has been used to cover expenses, the entry reduces both assets and equity. This example shows the replenishment of a fund for the exact amount of expenses incurred. However, this is seldom the case. This brings us to cash over and short. This accounts for the discrepancies incurred when the amount from replenishment doesn't equal the amount in receipts. Suppose a further $20 was required for replenishment, but the expense was unaccounted for in the receipts. As shown, the report would detail the replenishment amount as now $330, but total receipts would remain as $310. In any case, the account must be replenished in the amount owing. To account for this, a cash over and short is recorded in the amount of the discrepancy, which is $20. Here, the cash over or short is debited to show an increase in expenses, but in the case where the expenses are in excess of the amount owing to replenish, cash over or short is credited.